A number of factors have been weighing on the market, from oil prices to rising yields to a shift in expectations for monetary policy this year. So what matters most for where equities go next? Joining us now is Piper Sandler Chief Investment Strategist Michael Kantrowitz and Empower Chief Investment Strategist Marta Norton. Both of you, thank you for joining us. We do appreciate it. Marta, how would you characterize the markets here? Because prior to even this conflict starting, we were concerned about valuations. We were concerned about the impact of AI. We were concerned about that AI trade sort of wearing out and the displacement various sectors would face. And yet here we are embroiled in this conflict, and we're, what, less than 5% from highs?
Yes, right. There has been one problem after another for markets. Of course, the AI concern was a bit more localized, focused on areas of disruption, industries of disruption, and of course the Mag 7. And now we're looking at something with the geopolitical conflict that's far more widespread across the markets. But to your point, we're not seeing markets off all that much. And I think that suggests that investors are trying to weigh a whole number of different scenarios. There's, of course, the worst case scenario that we worry about with a long delay in opening up the strait and destruction to energy infrastructure. But there's also these more mild scenarios that act more like a classic shock where we do get a recovery quickly. And I think it's anyone's guess as to which scenario we're looking at today.
Michael, it's certainly easy to suggest that the S&P maybe is looking a little bit on the bright side, given that it's not down that much. On the other hand, we got to these levels 6 months ago. Earnings have continued to rise, so therefore valuations have compressed. And I think also there's probably taken a while for the narrative to shift and people to kind of come to terms with the idea we're not going to have a run-it-hot start to this year with the Fed cutting rates. So where do you see the risk-reward set up here, given you've seen some financial tightening around the edges?
Yeah, well, the conflict has now brought back the persistent anxiety around inflation that really got kicked off with the 2022 inflation shock. And since then, the last 3 years, besides AI earnings, the real most important thing for the markets have been the up and down in interest rates and where the Fed is going. And we got all the way to the record low credit spreads near the end of last year. As oil was low, interest rates had come down. The Fed was supposed to keep cutting. And all of that has kind of certainly been on pause or have gone the other direction. So I'm less concerned about the economy. I think the U.S. economy can certainly handle $90, $100 oil. I'm a little more concerned about interest rates and the fear of persistent inflation weighing on equity multiples. So the market's not down that much, and that's partially because the earnings numbers continue to move higher across large, mid, and small caps. But the decline has all come from multiple compression to the tune of about 6-7% so far. So it's effectively like we just wiped off 7% in earnings. Of course, that could be flipped around. We didn't. But if oil prices come down, of course, those multiples will go right back up and interest rates will decline as well. So we continue to see this as just an oil-driven one variable market. It's driving the bond market. Oil and interest rates are driving the equity market. And for now, I think markets are priced appropriately for where conditions are and will continue to move and react as conditions evolve.
Marta, would you agree with that assessment, or do you think that oil at $100, $90, let's say, that will actually impact the economy?
What I really liked about the Fed meeting last week was ironically what a lot of people dismissed, which was the summary of economic projections. And when we look at what the Fed was articulating there, we did see this spike to inflation for 2026, but we saw that roll through pretty quickly and inflation come back down to norm in 2027. We saw economic growth expectations revised higher and not necessarily a change to labor. And that reflects that classic Fed view that you can look through these oil price spikes. And that's what history does tell us. And so my base case is aligned with this view that we're not necessarily at a point of great vulnerability. But I think we do have to watch how this plays out, because there is a worst case scenario out there that we haven't really grappled with, at least from a market pricing standpoint.